Good morning, and very pleased to have a chance to talk to you about the Embark Horizon managed funds. Uh, I'll primarily talk this morning about how we see the world, and therefore how the funds are set up, what assets we favour. But just to start with, I am showing the strategic asset allocation for the funds. Just to remind you, the strategic asset allocation is set by eValue, an independent research company. And they base it on their long-term expectations for the returns for the different asset classes and the volatility of the different asset classes. They reset that on a quarterly basis. This is the current strategic benchmarks that we're working to. And then us at Columbia Threadneedle, we look to add value by taking tactical asset allocation views around the strategic benchmarks and by taking active stock selection in our internally managed funds. So moving on to how we see things at the moment and our tactical asset allocation views, they are summarized there. If we look at the top line at asset allocation, you can see that we are least keen on government bonds, and the two asset classes we favor are investment grade and high yield credit, i.e. corporate debt, and equities. If we start with equities, we've been enthusiastic about the prospects for equities for some time, and we continue to believe they have further to go. And the main reasons for that, if we look at the bubble above equities, you can see massive government and central bank support for growth in all the major economies. Central banks have kept interest rates down at very low levels, virtually zero, and have undertaken huge quantitative easing programs. And governments are very loose on fiscal policy. We've seen big expenditure packages from governments. Obviously, Biden very much leading the way in the US with three huge, great, well in excess of $1 trillion a time packages. And this is working. Economies are bouncing back sharply from the recessions caused by COVID. Certainly the central authorities have done a lot to help it, but consumers similarly are keen to get out and spend again after a very difficult 15 months locked up. They've got excess savings because they couldn't spend in the lockdown, and now they show enthusiasm for spending it. So we're seeing good growth. Secondly, I put there corporate earnings are strong. We've seen a very strong first quarter reporting season around the globe. And this year, expectations are that global corporate earnings in 2021 will be very close to 40%. It's a really good bounce back. Companies have come through in pretty good shape, generally speaking. And thirdly, the vaccine news has been very good. And the vaccine rollout is so key to getting back to normality. And efficacy is high, rollouts are good, and we are continually seeing additional drugs getting approval. And the more we have out in the marketplace, the quicker that rollouts can take place, which is obviously good. So equities, we still think are the most attractive asset class. They've clearly run a long way. They're clearly not cheap, but we do think they've still got the wind behind them and they've got further to go. Looking to the left on that top line, government bonds, as I said, are our least preferred asset class. We're not worried about government bonds. We don't see them weakening substantially, i.e. yields going up a long way. It's just that they don't offer much value. We'll talk a bit more about inflation, which we're not very worried about. We think central banks will keep interest rates low. So a perfectly good environment for government bonds, but on a gilt yielding 0.65%, or a German Bund yielding a small negative annual yield, we just don't see value. So looking at the middle line, equity regions, what regions do we like and dislike? Let's go over to the right-hand side, our favored regions. and our most favored is Asia ex-Japan. And a number of reasons. Firstly, that area has generally got through COVID quite well. Economies never went down as much as in the West. So economies are in good shape. But also, there's a huge growth still in Chinese wealth, and that is throwing up great opportunities in the area, um, in areas that benefit from consumer growth, such as insurance, such as travel, such as education, companies benefiting from those, which we think are excellent long-term investments. But also in the growing world of IT, we're seeing an increasing number of major players in Asia, the likes of Alibaba, Taiwan Semiconductor, huge semi production company, and semis are in such demand at the moment for everything. Samsung, you'll know, major consumer electronics company, some real global powerhouses. So that is our preferred region. We're also enthusiastic about Japan and the US. The US is something I'll talk about a bit more in a minute. Going to more specifically, it is an area we certainly like, although I put in the bubble there, we have trimmed a bit recently. We've been overweight for some time in the US. It's been the strongest performing of the major markets by quite a long way. So we have taken some profit, but do you still like it? Japan, we have added to the favor list more recently. And the reason for that is, and you can see in the bubble up there, due to the cyclical exposure. We do see, as I've said, coming out of the pandemic, economies are bouncing back nicely. And the more cyclical markets are the ones clearly that are going to benefit most from that. And Japan comes in that category. It's very much as a manufacturing, exporting nation and stock market. And as global trade picks up again, Japan should benefit from that. But the other thing about Japan, which has been slowly happening for a number of years now, is that companies are being managed more actively. Management are squeezing more out of the businesses. Poorly performing businesses are being taken over, which just wasn't part of the Japanese culture before. More people are being made redundant, which wasn't part of the culture before. Cross holdings between companies to protect each other, they are being wound down. So Japan is moving in the right direction in terms of getting the maximum out of their businesses. So we've added that to the list of regions we like. The other in the neutral area for regions, we've got emerging markets apart from Asia and Europe, and the UK is there. Just to mention the UK, it was in the dislike box at the start of the year, but we've put it up to neutral, and that is for a couple of reasons. A, it's underperformed, hence it's looking pretty good value. Secondly, we have done well when it comes to vaccine rollout. So having been lagging in the early days of COVID, and the economy was hit very hard, now with a good vaccine rollout, we are accelerating growth again, which is encouraging. But also we come in that cyclical category again. We are a very service economy, and it's services that have really been hit by this, by COVID, not manufacturing. They've managed to carry on reasonably well, but services, tourism, etc., have been hit hard. So as we come out of it, the UK is the sort of area that should recover well. So we pushed that up to neutral and added to our exposure. The other thing about the UK is we're seeing a lot of bids at the moment. We are very open to bids coming in, whereas some economies protect their companies. We don't. We're a very free, open market economy, and we are seeing a lot of bids at the moment. Morrison's, you'll all know well, obviously subject to 3 different bids at the moment, and our funds are benefiting from that. Columbia Threadneedle has about 9% of Morrison's. So we'll leave regions there. Looking at credit at the bottom, as I've said, We think credit, i.e. corporate debt, is more attractive than government debt. That incremental yield you get for the extra risk, we think is worth having at the moment. And within corporate debt, we think that high yield is more attractive than the higher quality investment grade. Firstly, you're getting a bigger pickup in yield, about 3% per annum, and that's quite a lot in a low return world. Secondly, defaults at the moment are running at pretty low levels, and where we are seeing them, we're seeing a pretty high recovery rate from selling off the assets. And high yield has a lower correlation to government bonds than investment grade. So for all those reasons, within bonds, that is our preferred area. And we have added holdings in the Horizon Fund. They didn't have any a couple of months ago, no high yield, and now all the portfolios have exposure to high yield debt. So that is how we see the world, our tactical views. And if we look on the next slide, we can see the relative positions we have to the E-value benchmarks in the 5 funds. So if we start on the left-hand side, the darker green boxes, you can see we're underweight bonds overall, and within that, particularly underweight the 2 lines on the left, government bonds, and more overweight high yield in particular, and a bit to some extent in investment grade. If we look at the greyish boxes in the middle, equities, you can see we're overweight equities overall, as we've indicated, particularly the US column, the Japanese column, and the emerging market column. Emerging markets here is primarily to get that Asian exposure I talked of. And an emerging market fund has about 2/3 of its exposure in Asia, which is the biggest part of emerging markets. And as you know, we have no property holdings at all at the moment. So that is how the funds are currently structured. I said I'd talk a bit more about the US. There's a couple of points I put in the presentation today, which I thought were topical and of interest. And the first one is why the US. A lot of people say the US is expensive and there's much better value elsewhere. We, as I've said, we have trimmed holdings on the strength, but we do still think it's an attractive market, and we are still above benchmark. So why do we still like the US? Well, first of all, the US economy is bouncing back very sharply. If we look on the left-hand side, that's just 2 indicators of the economy. The ISM manufacturing index is an indication of what companies are doing, it's company orders. And the other line is US retail sales. Both you can see have bounced back very strongly, real V-shaped recovery out of the recession. So the US economy is one of the strongest in the globe. If we look on the right-hand side, you can see the way that expectations have changed in the US. This is the dark blue bars are historical GDP. The lighter blue ones are expected GDP growth in 2021. And the lighter blue one, second from the right, is what the market expected growth to be in 2021 back in January. And the one on the far right is what it expected in May. Only 5 months later, expectations for this year had gone up from 4% to comfortably over 6%. That is, 6% is a very fast rate of growth and a hell of an improvement on what was expected only a few months ago. So good news as vaccine rollout come through, as consumers get back to spending in the US. If we look at the next slide, which is looking more specifically at earnings, and earnings are the important thing. That's what drives equity markets. That's what you're buying when you buy shares. Corporate earnings, which then come back to you in dividends over time. And if we look at the top right, that box saying 86%, that is, if we look back at the Q1 2021, the latest reporting season in the US, 86% of companies came in with results better than market expectations. That's a very high percentage. And they didn't just beat it by a bit, they beat it by a long way. The bars on the left-hand side show how much they came in ahead of expectations, 22% above market expectations. So companies, generally speaking, have done a good job in the difficult times. And if we look at the bottom right, more specifically, there's a lot of companies in the US that have come through very, very well, benefiting from COVID. The likes of Amazon, Apple, Facebook, Microsoft, Alphabet, the global dominant players in today's and tomorrow's industries. They have benefited enormously, and between them, their Q1 results this year compared to their Q1 results last year, profits are up 105%. So they are doing very nicely, and they are major players in the US. And this really is one of the keys to why we like the US. There's a lot of good companies to invest in. And when you want the dominant global players growing fast in today's industries, you do find a lot of them in America. You don't get names like that in the UK that you immediately associate with global winners. So when you want these sorts of things, when you want some of the major healthcare players, America is where a lot are. So that is why, one of the reasons why we still like the US. And just on the earnings point on the next slide, this shows on the left-hand side, you have got market expectations for earnings growth for the S&P index in America for 2021. So these are what the market is expected for this year. And on the left-hand side of it, that's what they expected for growth in 2021 back at the start of last year. And now we're expecting earnings growth for this year to be $190, whereas it was around 160. So you can see that earnings expectations for this year have been rising steadily throughout that period and continue to rise. And in fact, if we look on the right-hand side, again, we show earnings. The lighter blue line, which ends up on top, is earnings growth for the S&P, and the darker line just below it at the end is the S&P index itself. So basically, earnings have been rising faster than the market, which does mean, by definition, that the PE, the price earnings ratio, the price we put on those earnings, has fallen a bit over the last year. That's a year we're showing there. So it is an expensive market, but it is a little bit less expensive in PE terms than it was, because earnings have risen faster than the market. And it isn't just going up on hope value, it is going up because earnings are going up very nicely. So that is the US. That is why, although we have top sliced a bit, although it is quite an expensive market by international standards, we still think it has further to go, and we still like it. The next point I thought I'd cover, because again, it's a very topical point at the moment, is inflation. And very timely, only this morning, we had out the UK inflation figure for June, which came out higher than the previous month. It's 2.5% on an annual basis compared to 2.2 last time round. Yesterday, we had the inflation figure for the US, which is just over 5% at the moment. So really up quite a long way. So the question is this rise in inflation in a lot of economies a short-term factor, or is it something longer term that we need to worry about? Our view is it's a short-term issue. It's a spike. It's caused by COVID-related bottlenecks, dislocations, and in time, these factors will be sorted out and inflation will go back down to normal levels. And certainly we are seeing a lot of dislocation around the place, both demand going up in a number of just specific areas, and at the same time, supply being hit in specific areas due to these bottlenecks, which should be ironed out in time. I mean, if we look at the US inflation at the moment, it has gone up a long way, as I said, and two factors that have really pushed it up. One is second-hand car prices are up over 10%, and airline tickets are up over 10% on an annual basis. Second-hand cars, it is because there's a big increase in demand for second-hand cars because people don't want to go on crowded public transport to work. They'd rather now be in the safety of their own cars. So demand's gone up, but at the same time, supply has been hit. And there's a couple of reasons for that. Firstly, there's a shortage of new cars on the market at the moment because there's a global chip shortage. So manufacturers cannot produce cars at the rate they want to. The chips are so important to cars these days. But the second thing is that banks haven't been foreclosing on cars bought on credit during the financial crisis because governments have encouraged them to be lenient in the difficult times, and the supply of cars coming onto the second-hand market, a high percentage of it is people who bought cars on credit, can't afford to keep up the payments, and so they're claimed back by the banks who put them out into the second-hand car market. In the UK, we're hitting the same issue. In this morning's inflation figure, it said that second-hand car prices were up 4.4% on the month alone in May. But there's no reason why these issues should last medium term. We think they're temporary. Airline tickets, similarly, a year ago, there was no airline travel at all. It's still restrained, but there is now some of it. So airline prices have started to nudge up again from very depressed levels a year ago. In the UK, another area, I read in the FT yesterday, we are expected to hit squeezes in some vegetables, cauliflowers, broccoli, turnips, and cabbages, they mentioned. And again, there's just lots of issues at the moment post-COVID causing that. We haven't got as many Eastern European pickers, so wage costs have gone up. Transport costs have gone up a long way because we haven't got as many truck drivers as we had previously, because there hasn't been any training going on during COVID. Cardboard prices have gone up a bit because we're all getting so much online, and Amazon triple, quadruple packs everything cardboard. So for all these reasons, some of the vegetable farmers are saying it's hardly worth picking vegetables at the moment. So some isn't being picked, and what we are seeing is vulnerable to the prices going up. But again, we think these are temporary issues and should be sorted out medium term. On the long term, capacity will be restored where it is being hit. The long-term deflationary forces are still out there. Things like easier price comparison over the internet, squeezing out the middleman as we do more things ourselves. And the other thing is there's a lot of big productivity gains that we think will come through in time, which will free up more resources. Things like automatic supermarket checkout, things like drone delivery, which is being trialed at the moment. The post office is delivering letters by drone in a couple of Highland Islands, Scottish Islands rather. Driverless cars, app ordering in restaurants will all free up labour in the medium term, which will keep costs down. So we think inflation will return back to more traditional levels. And if we look on the right-hand side, you can see inflation in a number of major regions. And apart from the short-term spike on the right-hand side, inflation has generally been between 1 and 2.5% for the last 20 years. And we think it will get back down to those sorts of levels in the medium term. So we're not worried about inflation, although it will continue to spike in the short term. Moving on, just one other point I thought worth mentioning is that responsible investment, ESG, is something that we firmly believe in at Columbia Threadneedle. As responsible citizens, but also we think it makes sense from an investment perspective. We've always liked good quality companies. We believe they have the best prospects, and the same goes for ESG. Well-managed companies are the ones that score well when it comes to responsible investment. We think that they show that they are good companies and they will be the best performers. And it reduces the risk of things going badly wrong, whether it's from an environmental point of view, whether it's from a government point of view. Good ESG companies have less risk from that point of view. So ESG analysis is embedded in all our research processes, and we engage a lot with companies to make sure they're on the right tracks. We don't rule out investing in any particular sectors, but we are particularly cautious in sectors with issues to make sure we focus on the companies moving in the right direction, doing the right things. And I've just put here a couple of examples of companies we've engaged with recently. Amazon on the left-hand side, obviously phenomenally successful as a business, but they have been less successful on their sustainability credentials. But they know now they've got to up their game. Investors like us are putting pressure on them to improve in that direction. We're not entirely convinced yet that they have got the message fully on board, and we continue to engage with them, continue to monitor that they go in the right direction. Breedon on the right-hand side, a UK construction material company, very big in cement, concrete, aggregates, asphalt, the sorts of things that do tend to generate quite a lot of carbon. So the sort of company we want to watch very carefully. And we have talked to their head of sustainability that they've recently appointed, and they've recently appointed a non-executive director, particularly assigned to look at sustainability. We have had meetings with them, and we continue to actively engage with them to make sure that they stick to the roadmap that they've set out for reducing emissions. And they have started in that direction. Emissions were slightly down last year on the previous year. We want to ensure they continue on that track. So a lot of engagement takes place with our investments. Final point is on performance. On the next slide, if we look on the left-hand slide at the long-term performance since launch, you can see the funds have all produced very healthy returns for investors, between 53 and 134% in nominal terms, and sector rankings on those returns are extremely good, well up the ranking. If we move to the right-hand side, the shorter term, not bad returns nominally at all, but sector ranks not so successful. And there's a couple of reasons for that. You can see that the two more aggressive funds, 4 and 5, have actually done very well against their competitors. The more defensive 3, the top 3, 1, 2, and 3, have done less well compared to the competitors. And that is because these funds aren't managed against the peer group. They're managed around E-values benchmarks, which are designed to give good returns, appropriate returns for their target investment audience and their risk requirements. And they happen to find themselves in those particular sectors, and the sectors they find themselves in do have generally a higher equity exposure than the E-value benchmarks. And as a result, when equities are performing very strongly, these funds do tend to lag. So we've suffered from that in the short term, but also the value rally that I'm sure you'll be well aware of, that we've seen over the last 6 to 9 months hasn't been ideal for us. We do have a preference for really good quality companies that can show growth over the medium term. And they performed very well last year and before that. And the value stocks have got very cheap. But as people are seeing better recovery out of COVID than we'd had expected, the value stocks, the more cyclical stocks, have rallied. We've shifted our portfolios to some extent. We did anticipate that. We have added to cyclical exposure. You saw with the asset allocation, we added to the UK and Japan because of cyclical exposure. We've added to equity income funds compared to more growth orientated funds from an asset allocation point of view, and our regional equity funds have increased their exposure to more cyclical stocks to some extent. We've just shifted the bias a bit, so that has reduced the damage, but it hasn't been the perfect environment for us. We do prefer an environment where quality and growth are leading the way. That is all for performance. Just to summarize on the final slide, you've got the 5 Horizon managed funds. You've got 3 levels of oversight taking place. You've got Embark, the expert ACD. You've got eValue doing their strategic long-term asset allocation. And you've got us at Columbia Threadneedle adding value through tactical asset allocation and through active stock selection. And the Horizon funds all invest in in-house Columbia Threadneedle funds. And that means that I, as the overall fund manager, really know the strategy that our regional equity desks, our different bond desks are taking. It helps keep costs down. It also means effective governance. We can drill into the funds to make sure we're getting the right risk exposure, and it means we know we're getting the right sort of ESG RI analysis done. And long term, the funds have shown good outperformance, and we expect that over all periods in time. Thank you very much for listening. I'll leave it there. Goodbye.